One story which has sneaked under the radar is the latest decision from the Organisation of the Petroleum Exporting Countries, OPEC as it is, to cut oil production by 1 million barrels a day from early May. Now, Australia's been a member of the International Energy Agency since 1979. That means we are meant to hold 90 days worth of net oil imports. And we haven't done that since 2012. And in June last year, we had just 58 days worth, which is obviously well below target. The US Strategic Petroleum Reserve is now at its lowest point in 40 years. I don't really need to underline the point, but no oil equals big problems. And ahead of the Easter long weekend, drivers are being urged to fill up as petrol prices are expected to surge above $2. Joining me now is Head of Integrated Energy and Resources at Credit Suisse, Saul Kavonic. Saul, welcome to the show. Can you explain to us in simple language, because I know it's hard for many of us, including myself, to understand how we get to this point, what does this OPEC decision mean and why are they doing it?
Look, it was a surprise move and it was a significant surprise. Now, just very high level, we were looking at an oil market before this decision, which was actually a bit oversupplied at the moment. We actually saw some oil prices come down over the last few months. But as we expected the economy, an economic engine around the world, particularly in China, to grow, that market was going to tighten towards the second half of this year. And that's coming on top of what we have, ever since COVID, very significant supply chain challenges and a very tight market with very low stocks, particularly those strategic stocks that you mentioned. Now, what this decision does is it tightens up the market immediately today. And so that surplus is disappearing, and it could make things very tight in the second half of the year unless we do have a big global downturn. But what's very important and different here is the price point at which OPEC has made a cut is one of the highest on record. And the reason OPEC think they can cut supply even when prices are close to $80 is because Western nations, the OECD, most of the US, but including countries like Australia, have really dropped the ball on producing our own oil supply. So now we've really given the power back to the likes of OPEC, the Saudis, the Russians, who feel they can now have control and can squeeze prices. And we can't respond here in the West with more supply ourselves because we've implemented policies which make it a lot more difficult to bring on new oil supply and actually provide some competition with those OPEC nations.
So basically, in the name of, I suppose in many cases, climate change policy, we've hampered ourselves in terms of our own production. We don't have as much in storage as we are meant to have, which has put us in a position where other countries can leverage us by cutting off or reducing our supply of oil, so we have to pay more for it. Is that right?
Look, that's spot on, and it's been something that many in the oil and gas industry have been warning about for quite a number of years, but particularly the last few years, where we've seen climate change policy and particularly ESG pressures from investors, which have been abandoning support for new oil and gas. You don't have to look much further than obviously here at home in Australia, where over the last few months we've seen a lot of positive rhetoric supporting the gas sector from the government, but actions speak louder than words. And all the actions we're seeing is essentially a battle where the government is hurting the gas and oil industry across multiple fronts, whether that's price fixing, export controls, tax changes, the new carbon policy, funding environmental organisations to bring litigation against their own regulatory approvals. And in this environment, if you're a big oil and gas investor, you're simply saying, look, it's too hard to invest in places like Australia and also quite a lot of cross-border issues within states in the United States, and you put your capital elsewhere. And unfortunately, even Western capital is moving away from the sector, and that's leaving all the investment in the hands of national oil companies and national governments, particularly in the Middle East and in Russia, which are obviously less friendly than the friendly supply chains we'd prefer and we've relied on in the past.
It's just insane. We've done this to ourselves. It's going to cost the consumer more money, obviously, and I suppose it suits the government's argument. You should go out and buy electric cars and we need to move to renewable energy, etc., etc. But we're basically cutting off our nose to spite our face here, and there's nothing we can do about it now. We've gone too far.
Well, I think it's more of a case where we're just falling between two stools. So there's nothing wrong with, obviously at some point we need to decarbonise, and at some point we need to do all those green investments and so on. I mean, the real question is, why are we shutting down what works today before that new green future has actually arrived? And then you get left in a position of shortages, geopolitical situations which are less advantageous to us, and higher prices.